We are entering into, or just about there, the recession of 2020. So the question becomes, did we learn anything from the last great recession in 2008? In this video, I'm going to share with you some of those important lessons that hopefully you learned going back 12 years ago so that you don't miss out on putting yourself in a better place looking forward. Hi, I'm Mark Singer, and for timely, up-to-date information on these markets and retirement information, click on the link below to subscribe to our channel and hit the notifications bell so you're alerted to when we post new videos. So the very first lesson you need to be aware of is don't panic. Markets go up, markets come down. It's happened since the beginning of markets. Let's take a look very quickly what happened in and around the time of 2008. The markets were down from top to bottom, somewhere in the vicinity of 50%. I think the number was actually somewhere around 47 or 48%, and it lasted for about 17 months. After that market, the markets were up for, I believe, 129 months in a row for over a 400% return. Morningstar had done a study recently tracking the last 30 years of bear and bull markets. And the conclusion was that the bull market, when the markets are going up, lasts 3 times longer than the bear market, the market that went down. And that shows itself and evidences itself over and over and over again. That particular study went actually back to 1970. So every recession that we've had, every bear market that we have, we've come back up. Certainly no guarantees for any future performance, because certainly who knows, right? But as we look back at 2008, and we were in the midst of what we thought was complete loss of faith in the markets and a total worldwide economic collapse, a calamity, we not only came out of that, but prospered. So please make sure you do not panic. Keep proper perspective on this. You're not invested for next week, next month, or even next year. You're looking out 3, 5, 10, 20 years. So the important thing is don't panic. And then I'll move on to lesson 2, because it's not so much just stay the course, but lesson 2 is long-term strategies, long-term portfolios built on the premise of buy and hold, if you will. They work. So let's talk about this for a moment, because there's really 3 different approaches to take when it comes to investing and thinking about strategies. And I like to think long-term because I'm in the retirement planning business. We think out over 20, 25, 30 years. But there are people who like to time markets. So one way to invest is timing. The problem with that approach is that not only do you have to time it right on the way out, you also have to time it right on the way back in. There are many people who have made careers just making one of those calls correctly. Very, very difficult to make both. So as a long-term strategy or approach of trying to time markets, for the most part, our industry agrees pretty universally. It's not the approach to take because it's not effective. There are also studies that show that if you lose out on the top 10 days of a market over the course of a 10-year period, your returns drop in the vicinity of 50%. So timing certainly not a long-term strategy. Buy and hold is something we hear a lot. That is a strategy that does work over long periods of time, assuming, and when I say does work, that these portfolios are in alignment with what your goals are, okay? So if you need to be conservative and you have conservative portfolios, you remain conservative. If you have, riskier portfolios, you remain riskier. It's a buy and hold approach, and you do get through it. But the lesson that we truly learned coming out of 2008 was the buy-hold strategy with minor adjustments really helped us to come out of 2008 a little bit quicker than if all you did was just be completely passive and do nothing. So if you think about this for a moment, if all you did was just do buy and hold, your 60-40 portfolio, in other words, 60% in equities and 40% in, call it fixed income or bonds, as the markets were going up, that 60% in equities was going up. It could have ended up at 65 or 70% of the portfolio. And so you ended up with a 70-30 portfolio as the bull market was running its course. But what that meant was when the markets went down, you lost more money than you should have. Now a 60-40 portfolio, if you did nothing with it, is now actually somewhere in the vicinity of 50-50 in this market decline. So what we need to do is along the way, make minor adjustments so that we maintain the course and don't put ourselves at either too much or too little risk based on what our goals are. So the second lesson really is here, that the buy and hold strategy with very minor adjustments along the way can potentially be beneficial to you during times like this. Lesson number 3. Now, I have 32 years in this business, so I've been through a lot of this, and I'll just reference back to 2008 again. A lot of the buy and holds, we held our clients' hands through this. We were very proactive in front of them all the time, making, very minor adjustments along the way. We made it through. It may have taken 2-3 years to get whole, but then we were fine again. One of the opportunities, though, that truly exist during times like this. And you have to keep in mind this perspective, that more than likely from where we are right now, the next big move is up, not down. Can we go down a little bit more from where we are right now? Absolutely. But the next big move is up. So this is a time where you can take a look at either individual stocks or mutual funds or exchange traded funds or indexes or however it is that you like to invest in, and find those areas that have gotten hammered and do your due diligence on those particular investment vehicles to see who will be in a position to participate even more so when we have that big move on the upside, and start to weight your portfolio a little bit more towards whatever area you think or the expert thinks will start to come out of this sooner or with a more accelerated rate. These are some of the conversations we're having with our clients right now in terms of not just making sure they get through this, but trying to get a sense of where are we going to be in 2 years from now, and positioning the portfolio with minor adjustments to make sure that we get there and keep our eye on that ball. So the third lesson is there are opportunities out there that are presenting themselves, and you need to be pursuing them and doing your due diligence. The fourth and final lesson is, and this is where I find is the most crucial. I can tell you we have had numbers of calls with our clients, mostly proactive. I went out to reach out to our clients to see how they're doing. Not just financially, but emotionally through all the stuff we're dealing with the pandemic and everything else. It's very unsettling. And you're dealing with markets that are unsettling and emotions and lifestyles that are unsettling. Just want to touch base and make sure everything's fine. And the answer we get from our clients almost universally is, from a financial perspective, they feel fine. And the reason for that is that we do planning with them first, rather than go to the money and the portfolio like the rest of my peers seem to do first. My peers in my industry seem to focus more on the portfolio construction than making sure that the portfolio is in alignment with your goals. And that kind of begs the question as to whether or not you've actually stated what your goals are and done the planning. So the best thing we can do to help reduce the stress, take down the panic, help us get to where we need to be in 2 years, 5 years, and 10 years, is to know that we're on a path towards whatever success is defined for you. And that means that you must do the planning, and the planning helps us to get through this and understand that then, therefore, that the portfolio is in the right place, or if it's not, making the necessary adjustments. I hope that makes sense to you. It is important to not only just go through some of these crises and the Great Recession of 2008, but to learn from them as well and then apply what we've learned to what's happening now. If you would like to learn more about how we approach this with our clients, how we look to maximize their retirement income, hit the button below to see our master class. Thank you for watching. If this was relevant to you, if you enjoyed it, please hit the subscription button below. Hit the notifications bell to be alerted when we post new videos, and send it to a friend. Thank you very much for watching, and I hope that you truly enjoy the retirement journey.